What if the biggest secrets to building wealth weren't really secrets at all? What if they were just rules, kind of hidden in plain sight? See, the financial system has these built-in advantages that pretty much dictate how your money grows, how it gets taxed, and even how you own it. So today, we're going to break down those rules in plain English.
So, let's start with the big question everyone asks. Is the system rigged? And look, it's a fair question. It can definitely feel like this crazy maze where only a handful of people know the secret path. But what if, instead of looking for secrets, we just looked at the blueprint?
Well, here's the thing. The system isn't so much rigged as it is designed. Designed to encourage certain things, like saving, investing, and starting businesses. So these loopholes aren't really loopholes at all. They're intentional advantages, built-in features that are available for pretty much anyone to use. So in this explainer, we're going to start with the absolute basics, the rules for how money grows. Then we'll get into some really smart ways to use what you already own, how to leverage your environment, and then wrap up with the most powerful advantage of them all, just plain old patience.
All right, let's dive in. The first and most fundamental idea is all about maximizing your base. We want your money to grow with the least amount of friction possible, and it turns out it all comes down to where you decide to put it. Okay, so think of your money as living in different kinds of boxes. In a normal box, like a standard brokerage account, every single time you get a dividend or sell for a profit, boom, taxes take a bite. That's what we call financial friction, and it's a drag on your growth. But tax-advantaged accounts, they're like special, protected boxes designed to shield your money from that friction, letting it compound way more powerfully. And just look at the gap that opens up on this chart over time. That's the power of avoiding what's called tax drag. Tax drag is like this silent killer of your returns. All those little annual tax bites that stop your money from compounding on its full value. You get rid of that friction, and you end up with a whole lot more.
This brings up a really crucial difference in the system. Your salary, your earned income, gets taxed the second you earn it. But money you make from investments, that's totally different. It's usually only taxed when you sell. This means your investments can grow and compound for years, maybe even decades, before the tax man ever shows up. And that delay, that's a massive structural advantage.
And this right here is why things like low-cost index funds are so powerful. They have what's called low turnover, which is just a fancy way of saying they don't do a ton of buying and selling. And fewer sales mean fewer taxable events. This lets your money just sit there, stay invested, and keep compounding completely undisturbed. The system is literally designed to reward capital that just stays put.
Okay, so your money's growing nice and efficiently. Great. But what happens if you actually need some cash? Well, this next set of advantages is all about how you can access the value of what you own without having to sell and shut down that beautiful compounding machine.
Most of us think the only way to get cash out of an investment is to sell it. Simple enough. But there's a much more strategic way. You can borrow against your assets. This is huge because it gives you the cash you need to use today, while your original investment, it stays right there on the market, continuing to grow. It's how you get liquidity without triggering taxes and killing your long-term growth.
Now, real estate has this really unique advantage called depreciation. It's a bit weird, but the tax code lets you deduct a slice of a property's value each year for wear and tear, even if the property is actually going up in value. This creates two completely different realities. You can have real, positive cash flow hitting your bank account, but on paper, for tax purposes, you can show a loss. It's a really powerful incentive built to encourage real estate investment.
Here's another one of those fundamental shifts in how the system thinks about money. As an individual, you earn money, you pay your taxes on it, and then you can buy things like your phone or your car. But a business gets to do it in reverse. It can often pay for its legitimate expenses first, and then it gets taxed on whatever's left over. That means way more money stays inside the business to fuel more growth.
As your wealth starts to grow, so does your risk. And that's exactly why the system provides these things called asset protection wrappers. Just think of them as legal containers. An LLC, for example, puts your business assets into one container and your personal assets in another. This creates a firewall, so if something goes wrong with the business, your personal stuff, like your house, is protected.
Okay, now let's talk about the advantages that might be hiding right under your nose, the ones that are directly tied to your job and even where you live.
It is so easy to just focus on our salary, but honestly, some of the most powerful financial advantages come straight from your employer's benefits package. A 401k match? That's literally a 100% return on your money instantly. An ESPP often gives you a guaranteed discount on company stock. These aren't just little perks, they are structured advantages with returns you just can't get anywhere else.
So please, don't think of these as bonuses or some kind of optional extra. They are structured advantages, a core part of how you get paid, and they're designed to help you build wealth. Maxing out that 401k match isn't just saving, it's often the single best, highest return investment you can possibly make.
And think about this, where you earn and where you spend don't have to be the same place. Earning, say, a San Francisco salary while living in a state with a much lower cost of living, that can do more for your financial progress than getting a 10% raise. This kind of arbitrage just creates financial breathing room, letting you save and invest way more aggressively without having to sacrifice your quality of life.
And finally, let's talk about the one single most powerful advantage that really ties all of these other ideas together. This brings us to probably one of the most powerful ideas in the entire system: the difference between paper gains and realized gains. Your investments can double, they can triple in value, and as long as you don't actually sell them, you owe exactly zero in tax on that growth. Taxes only get triggered when you realize the gain, by selling. And this gives you an incredible advantage: control over timing. A salary gets taxed the moment it hits your account, automatically. But an investment, it can grow for decades before a single dollar of tax is due. This allows you to be strategic, to decide when to realize those gains, and lets your money compound on a much larger base for as long as possible.
And really, that's the ultimate advantage that ties it all together. The system isn't rigged, but it absolutely rewards strategy. And it rewards patience. It gives you the tool of time, letting your wealth compound, sometimes for years and years, before taxes are even part of the equation. So the only question left is, are you using that time strategically?